Your bank takes $12 from you every month just for keeping your money in a box. That's $144 a year. You didn't buy anything. You didn't use a service. You just let them hold cash that's already yours. This isn't a credit card annual fee or an overdraft charge. This is a maintenance fee on a basic checking account. The same kind of account that 63% of Americans use as their primary way to hold money. And right now, those fees are pulling $4.3 billion a year out of customer accounts, while the actual cost to the bank of maintaining your digital ledger entry is roughly 30 cents per month. The fee shows up as monthly maintenance fee or monthly service charge on your statement. Some banks call it an account fee. Chase calls it a $12 monthly service fee on their total checking account. Bank of America charges $12 on their Advantage banking account. Wells Fargo takes $10 for everyday checking. U.S. Bank charges $6.95 for their basic option, but $15 for anything above that. Here's what makes this number strange. In 1995, when most banking still happened in physical branches with human tellers and paper ledgers, the average checking account maintenance fee was $3 a month. Adjusted for inflation, that would be about $6 today. But the fee quadrupled in real terms, right? As banks moved everything to apps and automation that cost them 90% less to run. You're paying more for a service that costs them almost nothing to provide. And in 2 minutes, I'll show you the 3 specific account types where this fee completely disappears. But first, you need to see exactly what you're paying for. When a bank says maintenance fee, they're charging you for the privilege of them holding a database entry with your name and a number next to it. Every time you check your balance, that's a server query that costs the bank about 0.003 cents. When you make a debit card purchase, that costs them roughly 4 cents in processing. A mobile deposit costs them about 2 cents in image processing and fraud detection systems. Add up a heavy user who checks their account every day and makes 30 transactions a month, and you get to maybe 30 cents in actual technical costs. The Federal Reserve has published data showing that the marginal cost of maintaining a standard checking account with modern core banking systems runs between 25 and 40 cents per month per customer. Your $12 fee is covering a 30-cent cost. That's a 3,900% markup. Nobody puts this in the disclosure documents. That $12 fee isn't designed to cover costs. It's designed to extract money from the customers who don't read the fine print about waiving it. Because every single one of these accounts has a waiver system built in. You just have to know the specific thresholds. Chase waives that $12 fee if you keep a minimum daily balance of $1,500 in your checking account, or if you have direct deposits totaling $500 or more per month. Bank of America waives their $12 fee at $1,500 minimum daily balance, or with a single direct deposit of $250 or more. Wells Fargo uses the same $1,500 threshold or $500 in direct deposits. Notice the pattern. The fee disappears the moment you prove you're the kind of customer the bank actually wants. Either you're keeping enough money in a low-interest account that they can lend it out at 5% while paying you 0.01%, or you're routing your paycheck through them, which gives them first access to your money and makes you less likely to switch banks. The fee is a sorting mechanism. It extracts maximum revenue from customers who have lower balances or irregular income while making the bank look accessible to everyone. 41% of checking account customers pay these maintenance fees, according to Bankrate's latest survey. That means 59% avoid them. The fee isn't universal, it's targeted. You're paying $12 a month because you're either just below the threshold or you didn't know the threshold existed. The number that makes this genuinely problematic? Customers who pay monthly maintenance fees average $700 in their checking accounts. The customers who avoid the fees average $2,300. The fee is regressive. It pulls the most money as a percentage of balance from the people who have the least. If you have $700 and you pay $12 a month, that's a 1.7% monthly fee on your entire balance, 20.5% annually. A savings account pays you 0.5% if you're lucky. The maintenance fee is charging you 40 times what you earn in interest. Now the actual mechanics get interesting. These fees didn't used to exist at this scale. In 2009, the average monthly maintenance fee on an interest-bearing checking account was $4.37. By 2011, it was $5.48. Today, it's $12 at the major banks. What happened in 2009? The Federal Reserve dropped interest rates to near zero after the financial crisis, and they stayed there for over a decade. When banks can't make as much profit on the spread between what they pay depositors and what they charge borrowers, they started charging depositors directly. The Durbin Amendment also hit in 2011. That's the regulation that capped debit card swipe fees that banks could charge to merchants. Banks were making about 44 cents per debit transaction from merchants. The cap dropped that to 21 cents for large banks. They lost about $8 billion a year in interchange revenue, so they moved that $8 billion over to maintenance fees and overdraft charges. Revenue doesn't disappear from bank balance sheets. It just gets rerouted to a different line item that customers are less likely to notice or complain about in aggregate. You're not paying for account maintenance. You're paying to replace the revenue banks use to extract from merchants every time you swiped your card. The fee is a patch on a business model that changed when regulators restricted a different income stream. This gets specific and actionable now. There are 3 account types where this entire fee structure evaporates, and they're not secret premium products. They're accounts designed for specific customer types that banks want to keep. First type, online-only banks. Ally Bank charges 0 monthly maintenance fees on all checking accounts. No minimum balance, no direct deposit requirement. Same with Capital One, 360 Checking, Discover, Marcus, Synchrony. These banks have no physical branches. Their cost structure is low enough that they don't need to extract fee revenue to hit profit targets. The catch is, you can't deposit physical cash easily, and you're dealing with phone support instead of walking into a branch. Second type, credit union checking accounts. Navy Federal has 0 monthly fees on their checking. Pentagon Federal is 0. Most local credit unions are 0 or under $3. Credit unions are nonprofits that legally have to return surplus revenue to members. They can't charge you $12 to pad shareholder returns because there are no shareholders. The catch is, you usually need to qualify for membership through your employer or location or family connection, and their technology is often 5 years behind the big banks. Third type, relationship checking at your existing bank. This is the one most people miss. Chase has a Premier Plus checking account. No monthly fee if you keep $15,000 across linked Chase accounts or if you have a linked Chase mortgage. Bank of America has preferred rewards. If you maintain $20,000 in combined balances across Bank of America accounts, you get free checking plus credit card bonus category increases. Wells Fargo has portfolio checking. $25,000 minimum in linked accounts gets you 0 fees plus free checks, free wire transfers, no ATM fees worldwide. These accounts are designed for customers with enough assets that the bank wants to keep the entire relationship. You're not avoiding the fee. You're qualifying as a profitable customer through a different mechanism. Here's the specific calculation. If you have $15,000 sitting across accounts anyway, you're giving the bank $15,000 to lend out at current rates while they pay you maybe $100 a year in interest. That spread is worth about $600 a year to the bank in lending profit. They'll waive your $12 monthly fee because the $144 annually is nothing compared to the $600 they're making on your deposit balance. You're still the product. You're just a profitable enough product that they don't need to nickel and dime you. Now the practical reality. If you have under $1,000 in your account at any given time and you're paying $12 a month, you need to switch to an online bank or credit union this week. That fee is eating 2% of your balance annually for 0 benefit. Open an Ally or Capital One account. It takes 15 minutes. Transfer your direct deposit. Done. If you have between $1,000 and $5,000 in checking and you're still paying the fee, you're missing a waiver option. Check if your paycheck qualifies as direct deposit. Most do. Some banks are specific about ACH coding. If your employer uses a payroll service like ADP or Paychex, it will qualify. Set that up and the fee stops. If you keep more than $15,000 across multiple accounts at the same bank and you're paying checking account fees, Call them and ask about relationship checking. The banker has authority to move you into a fee-free product if your total balance qualifies. They want to keep your deposits. They'll waive the fee to prevent you from moving money to a competitor. What won't work? Asking nicely for a fee waiver without meeting a threshold. Banks have eliminated individual fee forgiveness for monthly maintenance charges. It's automated. You either hit the qualification or you don't. A branch manager can't override the system for goodwill anymore. That authority was removed around 2015 when banks centralized fee policy. Also won't work, keeping exactly $1,500 in checking to avoid the fee if that's money you need for expenses. The minimum daily balance requirement means if you drop to $1,499 for even one day in the month, you get charged the full $12. The threshold is a daily requirement, not an average. If your balance fluctuates, the direct deposit waiver is more reliable. Your bank is charging you $12 a month because their business model shifted from making money on interest spreads and interchange fees to extracting direct fees from customers who don't meet specific balance or deposit thresholds. The fee covers a 30-cent cost. The other $11.70 goes straight to profit. $4.3 billion a year across all customers paying these fees. You avoid it by moving to a bank with a different cost structure, or by qualifying as a profitable customer through balance or direct deposit, or by switching to a credit union that doesn't have shareholders demanding fee revenue. The fee is optional. It just doesn't feel optional because banks don't advertise the specific thresholds in plain language on the account opening page. If this made you check your last bank statement, hit subscribe. We're explaining every fee they hope you won't notice.